When people first get into Forex, they usually focus on strategies, indicators, or finding the perfect entry. But here's something most beginners overlook. The Forex market is heavily influenced by just a few major countries. If you understand who really moves the market, you start seeing price action very differently. So today, let's talk about the top 3 countries with the strongest influence on the Forex market, and why every trader should be paying attention to them. First up, the United States. This one is obvious, but it's impossible to overstate how powerful the US is in Forex. The US dollar is involved in nearly 90% of all currency transactions worldwide. That means almost every major pair has USD on one side. Whether you're trading EUR/USD, GBP/USD, USD/JPY, or even gold, you're indirectly reacting to what's happening in the US economy. The Federal Reserve plays a massive role here. When they change interest rates or hint at future policy shifts, the entire market reacts. Inflation data like CPI, employment reports like non-farm payrolls, and GDP numbers can create huge volatility within minutes. If the US economy is strong and rates are rising, the dollar tends to strengthen. If the economy slows or the Fed signals rate cuts, the dollar can weaken fast. Second, we have the Eurozone, led by the European Central Bank. The euro is the second most traded currency in the world. EUR/USD alone is the most traded currency pair globally. So when the ECB makes decisions about interest rates or stimulus programs, it sends shockwaves through the market. Europe's influence is especially strong because it represents multiple major economies under one currency. Germany, France, Italy, and others all contribute to the euro's performance. Political events, energy issues, and economic data from the region can quickly change the direction of the euro. And since EUR/USD is such a dominant pair, its movements often affect overall market sentiment. Third, Japan. A lot of traders underestimate Japan's role, but the Japanese yen is one of the most important safe haven currencies. During times of uncertainty, investors often move money into the yen. That's why USD/JPY and other yen pairs can move sharply during global crises or risk-off environments. The Bank of Japan has historically maintained very low interest rates, and their monetary policy decisions can create strong trends, especially when they intervene or adjust yield controls. When there's a shift in Japan's policy, it doesn't just affect yen pairs, it can influence global risk sentiment. Now, here's where this becomes practical for traders. If you know these 3 countries drive the majority of market movement, you can focus your attention on their economic calendars and central bank decisions. Instead of randomly trading every signal you see, you start trading with context. You understand why volatility is increasing and which sessions are likely to bring momentum. This is also where having the right tools matters. For example, using something like the Trading Management Solutions EA can help you manage trades around these high-impact events. It can automatically adjust risk, handle trailing stops, and even scan multiple pairs influenced by USD/EUR or JPY at the same time. So while the big economies are moving the market, your trade management stays consistent and controlled. At the end of the day, the Forex market might seem massive and complex, but a huge portion of its movement comes down to decisions made in Washington, Frankfurt, and Tokyo. Master these 3 influences, and you're already ahead of most retail traders.